First question comes from Tony. I often hear Motley Fool hosts discussing Berkshire Hathaway and Markel as companies that invest in other companies and produce a nice annual return for shareholders. But since they buy stock in other companies, aren't they like buying an actively managed mutual fund instead of an individual company?
Great question, Tony. Yes. When you look at Berkshire and Markel, they're both kind of diversified companies, but they're different. Berkshire is really big. They're over $500 billion company. And just to give an example, like one little piece of Berkshire Hathaway owns about $200 billion worth of publicly traded stocks. These are huge companies like Heinz and Crafts and Wells Fargo and American Express, those types of businesses, and they own big stakes in them, where Markel is about a $14 billion company, so 500 versus 14. So I'd say Berkshire's larger and more diversified than Markel is, but they both are doing the same thing. They own whole other companies and diversified revenue streams. And I think they're a good idea to have in one's portfolio in addition to the S&P 500. And as a matter of fact, if you look over the last few years on the performance of the S&P 500 in aggregate, how much revenues grew and profits and that kind of stuff, Berkshire has grown much faster. Their performance has grown much better. And I actually like them better than the S&P 500, although you're not quite as diversified. And they trade about like the financials ETF. So you'll find them, they'll go down. So 2008, 2009, when the financial ETF went down about 37%, so did Berkshire Hathaway. So it trades with it. But the business did much better. I like the idea of having some Berkshire Hathaway or Markel in your portfolio. And I think right now Berkshire's a little bit cheaper. So maybe that's a good choice for you if you don't mind having a company instead of just the S&P 500.
And with Berkshire, there's always a lot of concern about it's Buffett. It's all about Buffett.
Yeah.
Who's now 88.
Who's now 80. So there's good reason to have some concern that he maybe is not going to live forever. So is Markel similar in how it's structured? Is there one person at the top?
Well, it's similar in that it's been in the Markel family for a long time. It's the third generation now that's running it, but their next group of leaders is already in place and running the business. So co-CEOs Richie Witt and Tom Gaynor are in their 50s. They're running the businesses while they're overseen by Stephen and Tony Markel and Mr. Kirshner, who was the CEO before. So they have a younger group. I would also stress, though, I think nobody's as good as Warren Buffett is, and that's a fact. But he's not running all the individual businesses. Those are all run by great people. And now they're overseen by Greg Abel and Ajit Jain. Ajit is going to run the insurance businesses, and Greg will oversee the other businesses they have. And these are very capable, great people that they have in place. And all those people running those other businesses have done it themselves. Buffett has basically allocated the capital. And a few years ago, we hired people to help with that too. So they're getting more and more. So the bench strength is really strong there. So I think, does anybody want to see Warren Buffett go? No. But the people that are behind him are more than capable, and Berkshire will do just fine. So I think that's overblown a little bit.
The only thing I'll add is if you really are considering owning one of these stocks or both of these stocks versus an actively managed fund, just know that if you buy the stocks, you just pay the commissions and that's it. You don't pay any actively managed fee, which is anywhere from 0.7% to 1%. And actively managed funds are not very tax efficient. So if you were looking for money outside of an IRA or 401k, one of these stocks would be worth considering. And I should say that I own both of them.
I own both of them as well.
I own neither.